Welcome back to the History of Money series. In this episode, we turn back the clock and see how banks and banking practices emerged. And while money itself was being invented, why we also needed to establish ways to control it. Banking began when empires needed a way to pay for foreign goods and services with something that could be exchanged easily. As money evolved, coins of varying sizes and metals replaced fragile, impermanent, and uncontrollable paper bills. Wealthy people and rulers who imposed taxes began to need to store their money in a safe place, and ancient homes did not have steel safes. Wealthy people in Rome stored their coins and jewels in the basements of temples. They were given a sense of security by the presence of devout and honest priests or temple workers. Before long, temples also got into the business of lending money, much like modern banks do today. Julius Caesar, after establishing himself as emperor, was the first example of a major shift in power between lender and landowner, allowing moneylenders to confiscate land if there was a default in their loan repayments. Based on the theories of economist Adam Smith, some 18th century governments gave banks a relatively free hand to operate as they pleased. In 1778, the Royal Bank of Scotland invented the overdraft. The bank allowed William Hogg, a merchant, to take £1,000 more out of his account than he had in it, the equivalent of £60,000 today. In those times, bank accounts were a luxury for the rich, something that didn't change for more than 200 years. New banking practices promoted commercial and industrial growth by providing a safe and convenient means of payment, and a money supply that was more responsive to commercial needs, as well as by discounting business debt. By the end of the 17th century, banking was also becoming important for the funding requirements of the relatively new and combative European states. Numerous financial crises and bank panics over the decades eventually led to increased government regulation and creation of the first central banks. By the 19th century, banking had become a respectable business. Making a profit by basic money lending, banks paid a lower rate of interest for the money they took in than on the money they loaned out. As long as all the depositors didn't ask for their money at once, the banks could in fact lend out many times more money than they held in deposits. This is known as fractional reserve banking. On rare occasions, when depositors all tried to get their money out at once, there was a run on the bank, and the effect on the wider economy was so serious, the government started to insure customers' deposits to prevent it from happening. This regulation by governments of the banks enabled them to loan out more and more money. By the 21st century, some banks had taken fractional reserve banking to a whole new level, funding most of their loans not from cash deposits from savers, but with loans from other banks. Eventually, many banks couldn't respond when depositors wanted to withdraw all their money at once, and a lot of banks had to be rescued by governments. And some went bankrupt. Governments tried to prevent a global financial meltdown after economists distinguished between two kinds of money: money created by banks inside the banking system and money created by governments outside the banking system. When a bank creates money by making a new loan, the bank acquires a new private asset with an equivalent private liability to the borrower to pay it. This is money created inside the banking system. Governments can create money by selling new bonds. These bonds go into circulation as new private assets, but there is no equivalent private liability to pay them. Instead, this outside money is added to the public debt, although it's normally a very small percentage of the total money. This outside money was used to buy up the bank's bad private debts and write them off. The private sector retained its wealth with new assets inside the system, supported by the government with public debt from outside the system. In the next episode, we will discover the power of money and how our belief in its value affects us today and in the future.